Hey guys, it's your local neighborhood realtor here, Jeremy, with the Whitney Perkins team of Keller Williams, back with another video. And today we have a special guest with us, and I'm going to let him introduce himself, and we'll get into it.
Good morning, guys. This is Walter with Guaranteed Rate Mortgage in Gainesville. We're one of the top local lenders in the area and one of the top retail lenders in the country. So I'm excited to be with you today.
Yeah, so we're just going to, kind of do a little questionnaire, ask you a few questions, kind of help educate the people. First question, what's the biggest misconception people have about borrowing money?
There's a few things that come to mind. I think the first thing that comes to mind is the amount of money that you need in order to get into a house. We routinely help people purchase homes with less money than what it would cost them to get into a rental, right? We have down payment assistance programs. VA loans are 100% financing. USDA loans are 100% financing. Conventional is as low as 3% down payment. There's lots of grant options, local down payment assistance, state funded down payment assistance. And I read a stat one time that's kind of shocking that 40% of people still think you need 20% down in order to get into a house. And that's not the case.
No.
We help people get into houses. I've seen settlement statements where the buyer brings actually $0 cash to close.
Wow.
Yeah, pretty incredible. When you get into a rental, you have security deposit, first month, last month, right?
Yeah,
It ends up costing you $6,000 or $7,000.
That's very
It's
true.
much cheaper than that in a lot of cases to purchase a house.
Absolutely, especially around this area where rent is so high because of the university. You're coming up with $4,000, $5,000, $6,000 just to get into a rental.
Yeah, and then if you're moving, you have to get a sublease, or you have to pay a fee to break your lease, and that kind of stuff. The fees can really add up. So getting someone into a house for a lot less than 20% out of pocket, it's really beneficial, and that's probably where a lot of our first-time home buyers are moving right now. As you know, houses that are $250,000 are still flying off the market, and a lot of those buyers are using 3% down conventional, 3.5% FHA, or some form of down payment assistance.
Yeah, that's good stuff. I mean, and you guys have so many different programs that you use. Just speaking from experience, and the clients that I've sent you just to help people get in. So it's incredible what you guys can do. So good.
Just adding, I got a closing today, 2:00. The buyers bring $4,900 to closing.
Wow.
Right? That's almost what it would cost to pay security deposit first month for a lot of rentals around here. Yeah.
That's good. So how do you determine whether someone qualifies or not?
It depends on the type of loan. But for more the traditional types of loans, conventional, FHA, VA, USDA, right? The 90% of mortgage lending, there's three qualifications. There's income, more specifically debt to income ratio. There is assets and credit. I would say the most important thing is the debt to income ratio. So we want to see that the money that you're bringing in is being retained, and you're not dishing out all your money for monthly obligations, right? You don't have 14 different car payments or a bunch of different credit cards and things like that. Now, having some of that is okay. We expect a car payment, we expect student loans, we expect credit cards, but limiting the amount that is going out relative to the income is important. That's the most important thing. The second most important thing is credit. Credit will save you so much money in the long term. Right? Don't downplay the power of credit, right? So credit, I mean, you'll qualify for better rates, cheaper mortgage insurance on a conventional loan. So secondly, it's going to be credit, because that opens the door to qualifying for much more different programs, higher debt to income ratios, things like that. And then last but not least, I would say assets. But as we just discussed with down payment assistance and all these low down payment options, that's the least of my concerns in today's market.
That's awesome. And I had a question I was about to ask, but I got caught up in listening to what you're saying. Lowest credit score. What can it actually be? To get into a loan, for a home. What have you seen has been the lowest credit score that you can get approved?
So we have FHA, which will go down to a 500.
500.
We have no overlays on our
Wow.
credit, or no overlays on our loan programs, right? So we'll do exactly what FHA, VA, whatever they'll take, right?
Yeah.
VA specifically does not have a credit score requirement,
Wow.
right? Now they do have an automated underwriting system
Yeah.
that passes like a risk scorecard,
Yeah.
and that is the determining factor, right, of whether the loan is acceptable or not.
Yeah.
But for example, I'm working on an FHA loan right this very second that's pulling an approval at a 526.
Wow.
526 FICO.
Yeah.
With just 10% down.
Yeah.
Yeah. So if you're going to be on the lower
Yeah.
end, you may have to put a little bit more money down in order to offset the lower credit score, just in terms of risk and
Yeah.
getting loan approval. But we see it as low as 500.
Wow.
And 3.5%, 580,
Yeah.
590.
Yeah.
We'll get approved sometimes.
Wow.
Yeah.
I actually didn't think it was gonna be that low. I was
Yeah.
for sure like 540, 550, but 500 is incredible. So people out there,
Mhm.
you
Yeah.
can get approved. Just gotta find the right lender.
Yeah, absolutely.
Last question: what advice would you give to someone looking for their first mortgage?
I would say establish your credit profile. Work on any disputed accounts or derogatory accounts that are on
Yeah.
your credit. Try to get those cleaned up, because when you go to apply and then you're trying to work on your credit, it can become convoluted and delay your timeline a little bit. If your credit's not in a place where it can get approved.
Yeah.
So I'd say establishing good credit, cleaning up your credit if that's applicable to you, and then waiting on going out and buying a new car or a new
Yeah.
boat or a new RV, right? If
don't
you want
buy
to have
all the
some
toys at
fun,
once.
don't buy the toys at once, right? I would say buy the toys after you buy the house, because I'll give you a perfect example. I had a buyer about a year ago who was pre-approved for 300,000. She went out and got a new car payment for $800 a month, right? Now you may think that $800, of course, it's a nice car, but it's
Yeah.
nothing crazy,
Right.
right? But that actually hurt her pre-approval amount by 100,000.
Wow.
So it went from 300,000 to 200,000 because I had to take that 800 car payment
Yeah.
right out of what she could afford in the mortgage payment.
Right. Back
So
to the debt to income that you're
back to the
talking
debt to
about.
income because
Yeah.
it's a maximum debt to income. So if you take that portion and put it off to a car, now you reduce what you can get in your mortgage payment by that exact dollar amount.
Yeah.
In most cases.
Yeah.
So waiting on buying some toys, buying
Yeah.
new cars is always a great idea.
Okay. That's
Yeah.
awesome.
Mm.
Great information, Walter. Thanks for
Yeah.
stopping by and chatting with us.
Mm.
Walter's information will be down in the link below. Reach out to him. I've been working with Walter for about a year now. He does great work. Him and his team over at Rate do great things. So don't hesitate if you have questions. Walter and I both will be available. So thanks for watching. See you in the next one. Perfect. Wow.
That's pretty good,
That
huh?
was great.
Let's go.